What's up, everybody? Welcome back. Today we're going to be going over fair value gaps and a little bit about inverse fair value gaps. Um, Basically, we're going to be explaining what this confluence is. It's one of the ICT confluences or strategies, what they look like, and how we use them in an actual market, and examples of how you can use them and proof of them working in actual market. So, first, we got to understand that a fair value gap is made up of three candlesticks, right? So it's a three candlestick pattern. There must be three different candles to create a fair value gap, and these fair value gaps happen when there's either a large buy order area or a large sell order area. And the purpose of them is that because of that large movement in price, it creates a gap between wicks, which is an area where price can return to offer fair value and then start continuing down, right? So for a bearish fair value gap is represented by these three red candles here, right? So imagine we're in a bearish market, we're looking at a bearish fair value gap. What a fair value gap is a gap between the two top and bottom wicks that are within this middle candle right here. So to mark that out, we got this and this. I'm gonna mark that as just do black. So this right here would be our bearish fair value gap. And the reason is because we had a bearish candle here, the wicks top to bottom here. We have another bearish candle but had a large movement downwards, and then another one that created a continuous movement downwards that created this gap from this wick down to this wick. So this creates a fair value gap. Now, what we look for price to do with these fair value gaps, if it's bearish, is we have price continuing to go down here. We want price to return, offer fair value, right? And then continuation lower, right? So that's the purpose of our bearish fair value gaps. Make sure when you're identifying these fair value gaps, when you're back testing on TradingView, you mark it out from the bottom of the first bearish candle to the top of the third bearish candle. If there's a gap between them, it's a fair value gap. If there's no gap, so imagine imagine this wick here came down here, and then this wick came down here. This would not be a fair value gap, right? Because there's no gap between these two wicks. So this is not a fair value gap here, right? Now, let's look at, let me just mark this back out. Let's look at what a bullish fair value gap looks like, right? So same idea, right? We got a three candlestick pattern, but these candlesticks are going to be bullish, so they're going to be going up. Now, if you can identify this, right, the way we do that is we do it from the top of the first candlestick wick to the bottom of the third candlestick wick. If there's a gap there, that means it's a fair value gap, right? So it's the same idea as the bearish one, just flipped. So we're marking it from the top of the first to the bottom of the third, and we're marking it by the wicks, right? We don't mark it by the candle closure, we mark it by the actual wicks. So in a bullish fair value gap, what we look for price to do is we're looking for continuation up, right? So we come up, price comes down to offer fair value into that gap, and then we continuation up, right? So following that bullish trend, it's just areas where price likes to create higher lows, higher highs, lower lows, stuff like that. Right now, that's the super simple explanation of what fair value gaps are. Now, to explain inverse fair value gaps, it's kind of contradictory to what a fair value gap is, but here, it's basically when a fair value gap is respected or disrespected. When it's disrespected, it means price went through it, right? So if we imagine price went through this fair value gap, right? It didn't come in here and start rejecting downwards. It came through that fair value gap, and the candle closed above. This created an inverse fair value gap. In an inverse fair value gap, we look for a price to come back down here, tap into the inverse, and then continuation up, right? So a inverse fair value gap will be like if you're going to be trading reversals, right? So we come down here, say price taps into a higher time frame draw on liquidity. Like imagine there's a 1 hour bullish fair value gap here. Price tapped into that bullish fair value gap, right? But it created a let's say 5-minute bearish fair value gap. Now what do we look for price to do? Price creates a 5-minute fair value gap, taps into the 1-hour bullish fair value gap, and we inverse the bearish fair value gap. Now that bearish fair value gap now flips, right? So now we're going to be looking for taking longs because that fair value gap was flipped. We want price to come back down into it, and then we start going up, right? So that's what a bearish fair value, inverse fair value gap will look like. Now a bullish inverse fair value gap would be the opposite. So let's imagine there is a drawn liquidity up here, which it could be like, let's say, a 1-hour time frame, bearish fair value gap, right? What we look for, say price comes into that bearish fair value gap, and then price decides to reject off that, and then inverse this fair value gap, right? So meaning that it disrespected this fair value gap. We want price to now come back into here and continuation lower, right? So that's basically how we use bearish and bullish fair value gaps. Now let's look for some examples in where we could see some. Let me look some fair value gaps here. Okay, so if you see right here, we have a bearish 1-hour time frame fair value gap, right? So that gap would be from here, the top or the bottom of this first candle to the top of this third candle here, right? Creating this large gap, right, where price needs to offer fair value before continuing lower, right? So if we see price comes in, taps into the fair value gap, rejects a little bit, not enough distribution, price taps in again. Once price taps in, it's ready to start moving downwards, and that's what we see, right? We see distribution lower. That's just a simple example of how bearish fair value gaps work. Now this has been a very bearish market over here, but if we look at the bullish side, let's see. Here are some inverse fair value gap examples. We'll go over that in a second. We can just use this one. Right, so this isn't a great example of a bullish fair value gap because there's a series of fair value gaps here and it's the middle one, but we have the top of this candle to the bottom of this candle, price goes up, taps back into here, and continues up, right? So that's just how we can identify these fair value gaps during the market. Now you also got to make sure that they're paired with other confluences before getting to trades. But to go over inverse fair value gaps on the 1-hour time frame here, we see this large bearish fair value gap here, right? That bearish fair value gap, we're looking for price to come down, come back into it, and then continue down. But look what happens. Instead of coming back into it, price comes down, pushes through it, right? Creates that inverse fair value gap. Now this becomes bullish, and now we're looking for longs. Comes back into this fair value gap and shoots up, right? So that's just an example of a bearish inverse fair value gap. And then here we can actually identify another, which is a bullish inverse fair value gap. It's very small. Make this bigger. Right here, bearish bearish inverse fair value gap. So we create a bullish inverse fair value gap by coming up here. Price comes back down, inverses this gap, comes back up a little bit, but then starts dumping, right? So this is a good example of a inverse fair value gap. Now, and when I teach people, I normally tell them, like, if we're looking for inverse fair value gaps, we normally look for those off our entries, and that's what we enter off of. It's basically our last indication or confluence before we get into a trade. And to use these strategies, we gotta be able to pair them with either higher time frame draws on liquidity or other concepts that you're familiar with. So, like, for example, we have this large bearish fair value up here, right? We have price come down, price came back up, tapped into the fair value gap, came back down, inverse this 1-hour fair value gap, and then started dumping, right? So that's just like, you gotta be able to pair those confluences with other confluences before using them, because by themselves they won't work a large percent of the time, but when you pair them with higher time frame confluences or other strategies, then it becomes a very high percentage win rate. So I hope that helped explain what fair value gaps and inverse fair value gaps are, what they look like, and let me know if you have any questions, and join the free Discord in the bio below, because that's where all my strategies, everything explained will be. And thank you for watching. Good luck with your trading this week.